If you access your pension in the right way, you can save yourself a lot of tax and have a really flexible way to get at your money. So let's look at ways to avoid slipping up on your pension. With UFPLS, you take from your pension as and when you need it. 25% of each withdrawal is tax-free up to a maximum of £268,275. The 75% taxable part is taxed at your marginal rate of income tax. It's simple to understand, but there are a few drawbacks with it, which we'll explain in this video. One alternative to UFPLS is to take the 25% tax-free upfront in one go. But the disadvantage of this is that it can leave you with a large amount of money in a general investment account subject to capital gains tax and tax on interest and dividends. So generally, you're better off phasing how you take your tax-free cash. In most instances, a good way to take from your pension is to use Flexi Access Drawdown. And the way this works is that the first withdrawal from your pension would be tax-free. So you say take £20,000 from your pension tax-free. Then the next withdrawal could also be tax-free cash, providing you have enough left in your pot, or you could take taxable cash from your pension. It's up to you. You can be fully flexible. And because of this, you can basically take from your pension such that you can optimize your tax position in any year. Here's a submission from Standard Life to a UK parliamentary committee, and they say in the first part that's highlighted, they propose that UFPLS is phased out, and in the second part, they say it's because people risk paying too much tax if they use this option. I'm going to explain this more in the rest of the video. The first reason is that with UFPLS, you risk dying with tax-free cash still within your pension. So because you're only taking out 25% of each withdrawal tax-free, you're effectively going to have to take out either all of the pension or most of the pension before you run down all the tax-free cash. Whereas if you use Flexi Access Drawdown, you can take the tax-free cash in a more accelerated manner. And a further complication is that if you die after the age of 75, then all of your pension is subject to income tax when it's inherited, and even the tax-free part is included within that income tax liability. The maximum amount of tax-free cash that you can take from your pension might be reduced in the future, and for that reason some people are keen to migrate this money into their ISA, and really the only way to do that effectively is to use Flexi Access Drawdown. The next reason is that if you take taxable cash from your pension, you trigger the money purchase annual allowance, and you can only contribute £10,000 as a maximum into your pension going forwards. So for example, if you're working part-time and you want to supplement your income and you make an UFPLS withdrawal, then you're going to be subject to this 10k cap. Or if you retire and then someone makes you a job offer that you can't refuse, again, you're going to be subject to this cap. And if you have maybe a large salary, if you re-entered the workforce, or if you work in the public sector where employer contributions can be around 25% of salary, then you can easily hit this trigger point. If you have a large pension pot, you might want to move some of the tax-free cash from your pension into an ISA, since they'll soon both be subject to inheritance tax, and there's a risk that the maximum tax-free cash in a pension either doesn't grow with inflation or it gets reduced. Now, if you want to move the tax-free cash, then really you can't do it with UFPLS because you'd have a large tax bill on the taxable portion that you'd also take. So for example, if you wanted to take £20,000 tax-free from your pension under UFPLS, you'd have to take 60k taxable, and that would make you a 40% taxpayer. Whereas under Flexi Access Drawdown, you can move the tax-free cash over a number of years into your ISA without paying 40% tax. There aren't many articles by financial advisors comparing UFPLS and Flexi Access Drawdown, but here is one with the verdict that FAD wins by a country mile. Unfortunately, not all pension providers offer the full Flexi Access Drawdown, particularly some workplace pension providers. Most of the major personal pension providers, such as Interactive Investor, Hargreaves Lansdown, AJ Bell, do offer the Flexible Access Drawdown. And so the problem is that UFPLS was introduced because some pension providers just didn't have the IT systems that could cope with a drawdown product. And that's why it's now time to potentially overhaul the system of accessing your pension. UFPLS could work well for you if you have a small pension but a large ISA. So if you have, say, £200,000 in a pension, you could take that at a rate of like £20,000 or so over 10 years and burn through it, and then let the ISA take up the rest of the strain. And that would be quite a simple way to access your pension. And then also, if you have a large defined benefit pension, that could push you into the 40% tax band when you also collect your state pension. And so if you're accelerating the tax-free cash in the early years, you could be saving tax at 20% before you hit the age of 67, and then become a 40% taxpayer thereafter. So you could have used your tax-free cash in an inefficient way, and you might have been better off spreading that cash more evenly using UFPLS. A wealth plan enables you to model your wealth over time, as well as how you will take from your pensions and your ISAs in retirement. I'm an accountant with over 30 years experience, and my retirement calculator models not just the tax that you'll pay in retirement, but also it highlights the tax band that you'll be in so that you can take evasive action if you potentially find yourself in the 40% income tax bracket. It models both Flexi Access Drawdown and UFPLS, and you can run a different scenario against your base case to look at different tax profiles from using either different tax strategies or different amounts to draw down in retirement. I think a spreadsheet is much more powerful and flexible and transparent when it comes to modeling your finances. My modeling also includes how you utilize your tax-free cash over time so you can get the most out of it. In retirement, you can influence the amount of tax that you pay, and tax planning can easily be worth hundreds of pounds in your pocket. If you're interested in learning more, go to my website where you can book a discovery call. I'll put a link in the description.